There's a lot of folks that I know that were really talented, high risers in the industries. They had all this stuff going on. And then at some point, they pivoted and aren't doing it at all now, which I think is sad for the oil and gas industry because it's already hard enough to get young people to get in. But what was that catalyst for you? Why'd you make that switch?
Never intended to leave the industry. It was kind of like, we're value add investors, essentially. We just take assets for people that have optimized for ease and we just optimize for profit. But in storage, because of that operational leverage, how an asset is run makes a huge impact to the profitability of the NOI of the asset. A lot of times we're literally just like picking up money off the ground. I mean, we have a property we bought at the end of 23, so about 12 months ago, had an 8% note on it. And I just got an appraisal back. We're going to be able to refi at a lower rate, return about 30% of the capital, and then buy an adjacent acre and do an expansion.
Having recourse debt on a stabilized cash flowing asset that's got really good coverage ratio versus like in development projects or even in construction, you're like, okay, spending a ton of money for like 2 years. Like with the development stuff, it's like you're just writing checks for like a long time and not seeing much coming back.
I woke up in like 2022 and I was like, okay, this is going well. This is the first thing I tried. Like, how do I know this is my thing? Every single one of my Google business profiles, we manage one for each storage facility and then the garage door business. They were all suspended.
Carl, welcome to the podcast. Thanks for coming on.
Thanks, Max. Glad to be here. Yeah.
Both of us Tulsa natives. I just found out a minute ago, and we also have the oil and gas background and don't know you well, but met you through Twitter X now. And just you got a lot of interesting stuff going on from the oil and gas background to the real estate side. We have those common things. You've also done the small business world. Just start out with a quick intro, then we'll launch into it.
Yeah, sure. Thanks again for having me. My name's Karl. Was an exploration geologist for 10 years, went to the Colorado School of Mines, worked in Tulsa and Texas and have 6 kids. And kind of by way, I wouldn't call it an accident, but kind of an experiment turned into what is now a full-time real estate investment career. And I do some consulting in oil and gas, started a couple small businesses, home service businesses. One of them's continuing to grow, going well. One of them I shared recently, we're actually going to wind down. So had my share of failures and successes, and happy to share about all that.
I think the most impressive thing that you said was the 6 kids, man. Congrats on doing that. I've got 3 and so much work. It's so rewarding. But in this day and age, it's just people are having less and less, it seems. And that's, you want to talk about investments for the long-term return. That's a huge one. So just props for being able to do that. I just think it's, as a dad of 3, I'm like, anytime I hear anybody with more, I'm like, you have superpowers or something, because it is hard.
Yeah, it's unique. It's unique today. It wasn't as unique for a long time, but it is now,
Yeah, absolutely. Well, starting out like on the oil and gas side, there's a lot of folks that I know that were really talented, high risers in the industries. I know people that were like C-level or VP, or they had all this stuff going on. And then at some point they pivoted and aren't doing it at all now, which I think is sad for the oil and gas industry because it's already hard enough to get young people to get in. But what was like that catalyst for you? Why'd you make that switch? And just talk some about how you got into moving away from the industry.
Yeah. Well, I think it's an interesting story. I never had the intention of leaving. I was one of those people. I mean, I was a high performer. I went to business school and I thought, I was going to come back and I wanted to be eligible for those big roles. But I also in business school, really, it's kind of become popular to like be negative about business school. But for me, what I was looking for was a transformation. I didn't want to be I liked geology. I was a geoscientist. I was good at it. But I didn't really want that to be me for the rest of my career. And I didn't want to, so I was looking for a transformation. And so going back to school was definitely the hardest thing I've ever done. I mean, we had 3 kids when I started. We had 4 and we moved. In my employer's infinite wisdom, they asked me to relocate during business school too. So like, it was just a tremendous challenge, but I did get that transformation I was looking for. I really did start to see things differently. And that was a lot of the work that I did, not just because I got some new degree or anything, but it was just a lot of work. Anyways, one of the things I realized during that process was really two things. One, my employer, who I worked for, Apache Corporation, it the longer I stayed there, the less it really was aligned with what me and my family wanted for our family. They closed down most of the offices or sold most of the regions that I was interested in working at, and I decided we didn't want to raise our family in Houston, and so that was kind of the first step. And the other thing I realized is I looked around and like my all of my family, like aunts, well, mostly uncles, my grandparents, my parents, and my wife's family as well. Like they were all small business owners, almost pretty much exclusively. My dad was as a kid, and he now works for Walmart, so he kind of did the opposite. But yeah, I realized that, and I realized that I always do really well in smaller, like high trust environments and teams. And the longer I was at a big corporation and the closer you get to the fire, the hotter it gets. And I wasn't comfortable. And so those are some things I realized. So I moved back to Tulsa to join a private equity backed NGP sponsor backed company in Tulsa with some old colleagues of mine to start their second iteration, help them with that. And that was kind of my first entrepreneurial step in my journey, I guess, was really stepping away from the safety of a big corporation and taking some personal risk, taking some career risk. But I did it in a pretty calculated way with people I knew. And ultimately, now I'm realizing I'm talking a long time to answer a simple question, but yeah, that's kind of the journey. And ultimately, during COVID, we were planning to sell that business and going into the summer of 2020. Obviously, in March, I was on spring break and COVID kind of erupted. And then very quickly, it became clear that we were not going to be selling the business that summer. Um, we didn't have any debt. We had deployed the kind of the capital, proof of concept capital that we were looking to deploy. Results were
Was this the Oklahoma
good.
assets?
This was in Wyoming, the Powder River Basin.
Okay, it's the Wyoming assets.
Yeah,
Okay,
so
so I'm a little bit familiar with.
okay, yeah. So this Rebellion Energy was the company. Rebellion 2 is when I joined right before we started Rebellion 2. I had worked a lot of different basins, and so I brought kind of a differentiated lens and experience to that team, which was mostly Oklahoma focused. And yeah, it was really ultimately it was very fulfilling. I came we executed the idea that I brought, and helped convince NGP, who was really ultimately very trusting of someone that they didn't have as much of a relationship with, to go act on that idea. Most of the things that I could control and like that I could forecast went pretty well. Like EOG did some things I said I thought would happen. Niobrara became more mainstream. The Maui was put on the map as the two source rocks in the basin, and we ultimately drilled 2 wells and fracked a third, and they were all like really outstanding productivity. And they're expensive. It's hard to drill a cheap well when it's the first one. But any case, 2020 came and we were quickly went into babysitting mode. Essentially, I mean, it was just reduction of staff, and then just kind of decide who we were having weekly meetings, deciding who we're going to pay that week, what vendors we're going to pay, and it's just really terrible environment. But we were already set on this. I was already kind of thinking about what's next. And my business partner, who's partner there, Chris Weatherall, and I, we've known each other a long time. He kept bringing up real estate, which I had explored earlier on in my career as kind of maybe buying rental houses, kind of standard stuff like that. It always seemed boring to me. I was much more interested in going and acquiring a business. I'd been looking for a business to acquire with a business school classmate of mine. I really like operations. I like making bets on myself. Like buying a building, put it on leasing it, and then just like collecting checks did not sound interesting to me. And so, anyways, eventually that conversation, Chris was right. He showed me why it was a great time to get into real estate. Really low interest rates, inevitable inflation, and so try and get yourself some cash flowing, hard assets with good fixed rate debt. And eventually I decided he was right. And we ultimately discovered that there's some real estate asset classes out there that are definitely a real estate, but there's a business component that's wrapped around the real estate that it gives the owner a lot more operational leverage, basically, which got me excited. And we looked at marinas, RV parks, and storage. All of those are, the way I think about them is there's a lot of tenants per dollar of capex or per asset value. Shorter term leases, it's kind of the opposite of what most real estate investors look for, which is they want easy passive cash flow, which I'm convinced doesn't exist. But
Yeah.
I was interested
maybe
in the
triple
opposite.
net or something. Maybe
Yeah,
triple net.
that's as
You
close
hear
as it
people
gets,
say
right?
that.
Yeah.
Yeah.
Now that's as close as it gets. I actually think owning minerals is probably the ultimate passive income.
Yep.
And so, anyways, that we decided ultimately storage was the one that you could actually take a small bite size, bite of, and we did that the first one, and very quickly realized that we could scale it operationally and we could scale it financially. Like I had been before, leading up to that, we also were exploring starting our own oil and gas business. Timing was perfect, right? Like blood on the streets, pricing's low, distress. Like you couldn't pry money out of anyone, even with guys with like pretty deep track record and pedigree and whatnot. But then we brought up this self storage idea, and like everyone wanted to talk to us about it. Like friends, old colleagues, banks, they were all excited about it. And so we just quickly realized we could scale this, and that's what we set out to do. And I committed myself full time to it after about 6 months or 6 or 9 months. Left Rebellion and I never looked back. So that's
there.
Yeah, I just never intended to leave the industry. It's kind of like how it just happened. It's like I can't take my eye off the ball here, So
Well, you go where the opportunity takes you, and it's a similar story to we've got a real estate firm, and all the partners are from oil and gas, and now one of them is full time doing it, and he never thought he would be leaving either, probably, and it just got to the point of scale where it's like we need somebody full time on this, or it's just going to be a side thing, and it'll never reach the potential that we want it to. And so one of the guys went full time. The first question I have is, how do you make the full time thing work? Because I think the small scale, we're finally getting over that hump, but it's hard to pay G&A. It's hard to pay a living wage to full time employees when you're early on scaling real estate. If you have a big fund, you could charge fees potentially, but like, how do you guys think of that in terms of when you started at a smaller scale? How are you like, can this support full time staff?
Yeah, so there's a couple of points there. One, I'll just say it's sacrifice. Like I didn't make a paycheck for a while, and I had positioned myself, even going into Rebellion, and taking that kind of incremental risk. My wife and I lived modestly. We'd stacked, a bunch of capital for ourselves to put to use somehow at some point, and didn't know when or where. We had a big safety, kind of community around us of support, kind of to allow you to take that risk, right? But there are just financial sacrifices. I mean, just to some extent, to do it the way we did it. And then we got lucky. I was given a severance. I had a job for a while, which, frankly, we weren't being asked to do much. We would go to the board and say, "Hey, what about this? What about this? What about this?" And we were looking at mergers and other, ideas constantly. It was just like to crickets. And so that left just quite a bit of bandwidth for a while where I could kind of get this thing going on nights and weekends. And then I got some severance, which made it that helped. And then the final piece, the big piece to answer your question now is, we use global talent. My entire team that operates all 600,000 square feet of storage, handles all 200 of our customers any given day, is all overseas. Well, South America, Africa, and Asia. And they are extremely talented people that just don't cost as much. Is the bottom line. So that's the other answer to your question: how we can do it at our scale, without going and raising $100 million fund or something like that. So a couple different components there.
Yeah, we've utilized the same thing. We've got some remote talent that we use, and you can get full-time employees for much cheaper, which has
Mhm.
been, and they're great and they do a good job. And for them, it's a good living wage, and they're excited about the work versus if you tried to pay somebody here that they would not be excited, and
Mhm.
it would be tough. So
Yeah,
that's a huge positive.
I just real quick, I just found out the third person on my team since starting to work from us has bought a house, which is not on their 5-year plan. So it's like we're not taking advantage of anybody. We're seen as a dream scenario for a lot of these teammates, and we take good care of them and treat them very just like we would anyone else, obviously. So that's been really eye opening, and enjoyable.
What was like the strategy with, because self storage is one of the ones that I've been involved in a number of different real estate um, concepts, and we started out single family homes, and one of the partners had a bunch of doors in a retirement community. We've done land deals. We do the short term rentals. I've never done the storage side of it. What was your thesis going in? Is that we can get it at this price, and if we can increase rates or increase occupancy, then the value, it's all math basically? Or how did you guys look at it?
Um, yeah, I mean, so we're value add investors essentially, but in storage, because of that operational leverage, how an asset is run makes a huge impact to the profitability of that, or the NOI of the asset. And so, like I kind of mentioned earlier, like it's that operational leverage allows you to place a bet on yourself and on the team, in addition to on the kind of the location in the market, so to speak. And so we were more market agnostic and looked for opportunities where the way I explain it is essentially we try to buy a storage facility from an owner who they've optimized their operation for ease. For how can I, as an individual, it's semi-retired or retired individual, how can I make 100 grand of cash flow a year as easy as possible? And there's a lot of storage owners that's that's their prerogative, and that's fine. It's great for them. But what that means is, usually, practically speaking, what that means is they want to stay 100% occupied because they don't want to have to answer phones on the weekends or in the evenings to secure new tenants. Their rents are low because, again, they're trying to maintain occupancy. Um, they don't charge, they're not very aggressive on fees and enforcing policies and everything because, again, they don't want to deal with it. It's all fine. And the fact that owners can do that for so long and maintain healthy businesses, to me, is just demonstrates the resilience of the demand for the product. People will put up with a lot uh, in the storage industry. So we just take assets for people that have optimized for ease, and we just optimize for profit. And then my challenge all along the way is, how do I make all the work that's required to optimize for profit less work? So how do I build a machine that helps us do that? And that's been the fun part for me. Um, it's a lot of times we're literally just like picking up money off the ground. I mean, just by running the business a little bit differently. There's other ways of add value, obviously, too, that we've done expansions um, and repositioning and development. But yeah, that's the main thing.
Yeah. Well, we've seen it too. I mean, because when we started with the short term rental stuff, we were
Hmm.
building a bunch of them. And so that was a lot of work. So because we were like focusing on construction.
Hmm.
And so then you had like a management company helping us with the rental side. And then once we got through a lot of the construction that we were doing, you start to put a harder focus on the management side, and you realize there's just even value lost there. It was like,
Hmm.
hey, they're nickel and diming us for this, or like, this doesn't look right, or they're making a spread on this weird fee that they're charging. And so we eventually this year took over and self managed the portfolio. And it was little things like bidding out the propane we like had a propane contract and it's going to save us like 15 grand a year. I mean, we have heated pools in all these places and we're
Yeah,
paying
yeah.
all this money for propane. And it's like, that was a phone call and we saved 15,000 bucks. So it's
Mhm.
like, you just start to, and you extract, and that's a microcosm for the entire business. You start to look everywhere you unturn something. It seems like you can find some efficiency that you can gain. And so it's just like, whether it's marketing, whether, operations, preventative maintenance, I think people will be shocked at, I think I tweeted the other day, it's like, the more you focus on something, nothing's a passive side hustle. It's like the more you focus on it is going to directly correlate to how successful it is. Do you?
Yeah. Yeah, I do. And I think, positioning yourself where you can focus like that is important. You know, I, one thing that I talk about a lot for my investors and my team, and I try to create is alignment and incentives. And I saw so much perverse incentive and just misalignment in the past. And as an engineer and kind of like an idealist, honestly, like those things used to agitate me and bother me a lot more than they do now. Like that's part of becoming a business owner, is you have to have a higher tolerance of um, disorder and things like that. But I think, just like you said, you were incentivized to make that phone call. Like if if people will hit the easy button every time. If there's an easy button, it's going to get hit. And so as owners, we have the incentive and we're aligned with um, doing the extra work, to create value. So that's one thing I just really enjoyed about, and ultimately what put me at ease with departing the industry and not really looking back was I did realize, in the upstream oil and gas space, it's extremely difficult and rare to find yourself in a position where you really have ownership and control. Just because it's the combination of capital intensity and risk, it's harder, and it's a consolidating industry. So it's even, I think, in the future even less likely. Now that for services and oilfield services and software, there's more opportunity, I think, for entrepreneurship that's more approachable, and we're seeing that, I think, with just in different spaces. But as a geologist, someone who's like, what I want to do, my grandfather, he owned an operating company that he started from scratch and ran for 50 years, and like the prospects of doing that at scale are just really hard. And so I've enjoyed being in a smaller scale, different industry, but where it's anyone can get into real estate and ultimately do something big. I see it all the time. People who started out with one house and then they got a duplex and they got quadplexes. Next, they bought a small apartment building and now they got a $50 million multifamily fund and they're really good at what they do.
It's so much more actionable, real estate is. And the
Mhm.
thing with upstream oil and gas is that they, like my partner that left the industry is an upstream guy, more on like the finance side, but he's still to this day is like, man, I just wish that like I could have done it or could do it in the future at scale. Cause you see the guys that have access to like $1 billion war chest and they can go out and like buy the right rock and actually run rigs and actually do the trades and things they need to do to shore up their positions. And they just have all this leverage versus a guy that has 10 million of capital or 5 million of capital. It doesn't go far
No,
in
yeah.
oil and gas.
And he might have great idea. He might have it. It's all about capital. Um, and
We had this
so
idea that, yeah, go ahead. Sorry.
I'm just saying, so that gave me a lot of comfort. Like, I'm probably not going to find myself in that chair. So where can I do that? Where can I get myself in that position?
I won't go down the rabbit hole I was going to go down. I was going to tell a story, but basically to echo to your point, the real estate side of things, it's so actionable. There's
Mhm.
always another deal out there, right? You miss out on an asset or you don't get the thing you want to buy and you're bummed. And then you got to remind yourself it's real estate. Like there's going to be like in the next couple of months, you're probably going to find 2 or 3 things that are interesting. And so the fact that if the leverage is really good, you can get really favorable lending.
Mhm.
That's just not accessible to a lot of industries. You can you can make serious money off of relatively small scale bets if you buy something right and then do the value add like you guys have done, the on paper equity value of that asset can jump,
Yeah.
you know?
Mhm.
And so there's just all these levers you can pull, and it really is something where you could scale it from something small and look up in 5 years and you've got something really big, even just through
Mhm.
even through organic growth, even if you didn't take on investors. But if you have
Yeah.
investor money too, it even turbocharges it.
Yeah, we started raising money. We intended to, the first several deals, we were just going to buy them with our own capital. And but like I mentioned earlier, like so many people were so interested and wanted to be involved that I decided, like, well, we should just start now then, because that'll just get us to learning what we need to know sooner. And That kind of mindset has served us pretty well, just like, taking every opportunity you can to learn so that you can compound that knowledge in the future. And we do that all sorts of places. But
So what's the
yeah,
monetization path for this stuff? Is it stabilize, get the P&L short up and cash out refi on these? Is it
yeah, and that was
build a
the
portfolio and flip?
it's it is ideally, it is to recap, return as much equity as you can into, good longer term debt. We were able to do that in our first five partnerships, and now those we did those after about 12 months. That's one of the beautiful things about storage, and why and it's another reason why we didn't do any development or any construction for the first several years, because we figured out we could buy an asset and generate a ton of value very quickly, like in months. I mean, we have a property we bought at the end of 23, so about 12 months ago, and had an 8% note on it. And I just got a appraisal back. We're going to be able to refi at a lower rate, return about 30% of the capital, and then buy an adjacent acre and do an expansion. So we could have returned all the capital, but instead we're reinvesting some of that to grow the business. Like we did that in 12 months, and if you built ground up, for example, like you've done, like, it takes time and the value's there, but it takes time. And so for us, first several years, I was like, I don't want to mess with that, because yeah, maybe the opportunity's there. It's not our specialty. And we can go create similar returns very quickly.
Well,
Um,
it's all about like finding the lever. And for us in our space, it was the construction was the lever, because anything that was turnkey and doing really well, there was two sides. It was either doing really well, and so they wanted a super high price for it, or if
mhm.
it seemed like a good deal, it's like there's a reason it's a good deal. Is because the
Yeah,
property's not that great. It's not in a
yeah,
good location. You're going to have to spend money, like put in amenities or do something to it to make it really perform. And so for us, the lever was, if I can build these for 30 or 35% cheaper than, what a retail price would go for, that, it took longer. And I will say we probably underestimated just the pain of construction a lot of
mhm,
times. I mean, it's just
mhm.
everything is harder than you think it's going to be. There's always something that comes up. But that was kind of the lever. And for you guys, it's like you found the lever, which was we can come in and there's a way for us to create immediate value
Yeah,
or in the short term, right? And so
yeah,
for us, it was the building it, because then as soon as it's done, you get that appraisal in. It's appraising for way more than what you spent, and you're like, that's huge. How do you think about the returning capital when I'm presumably you guys are still on the hook for the debt? Do you ever just like, I mean, that's because we've never done a cash out refi with our stuff. We'll probably have an opportunity to. We have a lot of it's really low rate fixed long term debt, so it's
same.
hard to want to
Yeah,
do it. You know what I mean? So we're like, I guess we could do this, but then we're at a higher rate, and then there's always the feeling too where it's like you return a bunch of this capital through the refi, but then you're still on the hook for the debt. And it's like, if it goes through a rough patch, what if you had to call capital back? I mean, I don't know. I always
mhm.
just kind of struggle with that thought because we've never really done the cash out refi, but it's like,
Yeah. It's a good question. I mean, and it's something. I mean, all of our debt right now is personally guaranteed by the sponsor, not by our LPs. And so, yeah, there's a little bit of a. I think it throttles, like, it makes us in a way it's good, because I don't have a misaligned incentive to go, like, really lever up this asset to, like, crystallize a waterfall or whatever. Like, I'm still on the hook for the additional capital. So use prudence. And that's just what we've done. I mean, we were able to refi into like 1.5 times debt coverage where we feel really good. And now those same properties that we refied like 2 years ago, they might be 1.75, 1 point, or even 2 times debt coverage. So you feel really comfortable. I sleep good at night. Um, and then but right now, like some of our assets, what we're looking at is there's non-recourse options available for some of our assets that are a little bit more institutional quality, say, and with several years of stabilized P&Ls too, that helps. But it's hard right now because most of those are in the interest rates are in the fours, and some of them have ceilings. Like some of our loans have rate caps that, well, not a rate cap. They have a capped variable interest rate for the second 5 years of the note, where it's like I don't have to mess with these for a long time, up till 2030. So yeah, but it's a good point. I mean, ideally, you go find agency debt, which is non-recourse, to kind of mitigate that. But
It's hard to do. It's easier said than
it
done.
is. Yeah.
It's and there's a difference too between having recourse debt on a stabilized cash flowing asset that's got really good coverage ratio versus like in development projects or even in
Yeah.
construction, you're like, okay, spending a ton of money for like 2 years. Like with the
Hmm.
development stuff, it's like you're just writing checks for like a long time and not seeing much coming back. And then, at some point you start to see it come back. And then in a success scenario, you pay off the debt and then it's all just dividends in a development. But yeah, it's a different kind of stress, I would say, versus just
Yeah.
buying an asset where it's cash flowing and you're like, yeah, worst case, if we were short for a while, but you're still covering some of it versus a project with like no cash flow, you're just burn rate. And that's a lot more stressful. And
Yeah.
the types of recourse debt I've taken, it's the
Yeah.
ones with
No,
no cash flow is where they're more stressful.
yeah. It's takes a lot of conviction, and I tell people like I got my fill of that kind of action uh, as an exploration geologist. Putting ideas together that were novel or riskier, and not having to write. I wrote the check once, but I've seen enough of that, and I don't. It just doesn't do it for me really. Like it doesn't get me as excited.
My
But
dad's a geologist and did the prospecting thing. And he's like, unless you're comfortable just like flushing $1,000 down the toilet and hoping
yeah,
that 2,000 pops up the next day or nothing, he's like,
yeah,
then you probably shouldn't be in the exploration business.
yeah,
So
yeah,
it's rough. But I think what the other thing that's interesting to me that you're doing, well, I don't want to close out real estate yet. I
yeah.
guess just thoughts on, I want to talk about the small business stuff, but
Oh yeah.
for real estate, into the future, is it stay in the same asset class? Is it stay in the same like geographically? I don't know if you guys are spread out or if it's all in one market, but just your thoughts on the current trends in today's market, where
Hmm.
you guys see opportunity, where you see headwinds, and what's kind of your plan or tentative plan.
Yeah. Um, so we have focused on self storage in the heartland. I call it um, Texas, Oklahoma, Kansas, Missouri, Arkansas, Nebraska. All of our assets today are in Oklahoma and Kansas. We had one in Arkansas. This is the only one that we sold. It's our very first deal. It was just a little small and a little far away. Um, we were going to continue to stay focused on storage. We have done one light industrial deal in Oklahoma City. Um, we would like to do more, but right now it's paying to, the market's difficult in most asset classes right now. So we're just getting more traction on storage because we're so embedded. We have a lot more relationships, a lot more expertise. We have markets that we know very well because we're already operating there. And so that gives us an advantage over coastal money that's just looking at, PDF or whatever resources they can get their hands on. So we're going to continue doing that, and I would see us expanding our footprint probably over time. The other thing we've done is we've syndicated, for the most part, one deal at a time, which usually that means one asset. A couple of times, just if things time together, we'll put two assets together in one partnership. And I would see us probably changing more, probably using a fund structure. Small fund, still tactical, still surgical. But a lot of times we're doing small, like self storage. There's no 30 million. Well, in our markets, there's no like 20, $30 million storage facilities. They're mostly $1 to $4 million. So that would be most of the assets in our kind of target markets. And so just administratively, um, it's it's a lot of deals you have to do something really material. Whereas someone in multifamily, they could go do one apartment building a year, do one deal, one fundraise, and still put a lot of capital to work. So I would see that being the one change we make. I struggled with this for a while though. This question of um, do you do the one thing or try other things, and um, it's pretty common for people to say stay focused, keep doing what you're doing, and that'll just pay off. For us, I woke up in like 2022 and I was like, okay, this is going well. This is the first thing I tried. Like, how do I know this is my thing? It's the first thing I tried outside of oil and gas. And so we looked at short-term rentals. Picked up the conversation about RV parks again. We've made offers on some of that stuff. I think there's a lot of other assets where our mindset and our approach to operations could give us an advantage. But so far, we've just been rewarded by staying focused on storage for the most part. Um, I'm curious to a fault, so like I have to constantly remind myself of that. Yeah, that's kind of it.
It's hard to know, like you said, unless you do different things. I mean, for us, I think I've gravitated toward. I really like transactional deals in real estate. Like, I love whenever you sell something.
Mm-hmm.
And so with our stuff that we're doing now, we're getting really good at operations, but operations is it's a lot of work.
Yeah,
And that's like the conversation we had earlier. You got to squeeze every penny. I think my favorite thing so far has been subdividing land. It's expensive up front if you do it at the scale we did, which looking back, we did it at probably a much bigger scale than we should have, but it worked out. But I just like transactional things where you can get in and get out over some defined time period and make a multiple on your money. But to each his own. I mean, the operational thing though, like if you're good at it and you buy the assets right and do what you're doing, it really creates like a really powerful stream of cash flow that
yeah,
can provide a great thing to live on and real stability around G&A and scalability. So, flipping deals, it's hard to get scale with that. You know what I
yeah,
mean? So it's just kind of like there's trade-offs no matter where you go.
yeah. And in storage, there because of the deal size, like there is a multiple expansion with portfolios, and so but there's also a minimum viable portfolio to operate yourself. A couple things changing in storage. Like when we started, there was a couple of third party managers out there that you could hire. They were not good. They would not leave you satisfied as an owner at all. Like for some people like us who are um, trying to really optimize things and be aggressive. There's a lot of new entrants in that space. So I think that makes the viability of third party managing and buying and flipping in and out of assets a little bit easier. Um, I think the other thing that you get with scale is from a marketing standpoint. That's a really big deal. Storage demand is a local supply and demand problem. And so Google local search drives a lot of the leads. And so if you have a domain with a lot of authority and you buy a new location, like we can provide instant ranking to new locations on our platform, which you may or may some third party managers offer that something similar to, but others don't. That's a bit of a moat for us, as we scale. I could see us scaling up and selling chunks of the portfolio to create liquidity and kind of do that surgically over time, but maintaining enough scale to keep the operation viable. So we'll just have to see. I also like the cash flow, and we've done a good job building a machine that, I'm involved, but like, I don't deal with a lot of stuff that we dealt with the first year or two, on a
Yeah,
daily
right.
basis. So
You build the mousetrap, like you said earlier, and then it's like
yeah,
you always got to come in and fix things when it needs
yeah,
it. But no, it's awesome, man. I'm really glad to. Like I've said, I've not done self storage. I've really not talked to anybody on the podcast that's been doing it. So
mm-hmm.
super interesting to me. What about the small business side? I mean, like
Yeah.
I maybe talk about the one that you're winding down now, because I think that that's always interesting for folks, is to hear that everybody just wants to talk about the success stories on
Yeah.
social media, right? I
Yeah.
mean, I've had some businesses that we've either operated and invested in that didn't pan out, and I've had deals like venture. I'm so My luck on investing in venture stuff is just terrible. Like, I feels like I put money into businesses and I'm like I'll probably never see this again. But just some of the failures, or at least start with that.
Yeah.
And
Well, I would say, with our deal at Rebellion Energy, kind of going backwards a little bit, but I would consider that a failure. I mean, those assets are still performing. NGP still owns them, and I think most of what I said, though, most of what we set out to do that we could control, it went well. Um, and so that left me pretty resolved. It was like, okay, I brought the idea, we executed on it. Everything that we could control, that I said would happen, happened. Didn't materialize into a big windfall for me, but that's okay. Like, it was giving me some confirmation that I know when a good idea when I see one. Um, but I would consider that a failure. But then more recently, what you're asking about, I mentioned earlier, before we got into real estate, I really had set out to try to buy a business. We were looking. My friend and I were looking for like logistics businesses, or like small industrial, like small manufacturing assembly type businesses, and got really close on one. I wish I might still go try and buy it from the guy who ended up buying it now. But anyways, that's what I wanted to do. And so once this real estate thing had gone down its path and was kind of stable, 2023 was pretty slow, right? Because interest rates had gone up and we weren't really acquiring as much. And I had more of a team. And so I thought, oh, I should start up the small business search again. And I realized, like, I don't need to buy one because I have time. I don't need a paycheck, thankfully. And I'll just start one from scratch. I don't need to. I don't need more PG loans either. I mean, like you said, I'm used to PG in a loan where it's like got a stable, very diverse recurring cash flows, or revenue stream. That's fine. Putting a PG on a small, like, $1 million, $3 million service business, which is what I was looking. I wanted to have a kind of asset light, cash flow heavy business. Didn't make sense to me. So we set out and started a garage door repair and install business called 360 Garage Door, September of 23. Great industry. I mean, the HVAC, plumbing, electrical, those are all really in vogue. Crazy multiples. Private equity is consolidating like all over the country. Margins are good, but tons of competition. I mean, everyone is doing that. The garage door industry was behind as far as the consolidation goes. Much more fragmented industry, but still really good margins, because there's a heavy component of the revenue is really you're selling products like these doors, openers, gate operators, that sort of thing. And so that allowed for really good margins. And so we started that, and it was going well through February. Like, we just kept scaling. We had a great technician. On February 6th of 24, every single one of my Google business profiles, we manage one for each storage facility and then the garage door business. They were all suspended at the same time that morning. I remember that morning vividly because one of my employees called me. He's like, "Hey, all these got suspended, and then the garage door one was suspended," and that was a nightmare. We got them all reinstated except for the garage door profile. And so for those of you that just don't know, like, if you search for garage repair near me or plumber near me on Chrome or Safari or anything like that, Google prioritizes, those are local service for local type services, local demand. They're going to prioritize, even if you're in a browser, like Google Map Pack. Those are going to be Google business listings. It's a listing that a business owner gets for free. Google verifies essentially the business and the location. and then you can link to your website, your phone number, everything. So it's free. That's where Google reviews go, and that is what Google uses to prioritize any sort of location-based business or service. So if you're a service-based, local or service-based business, and you don't have that, it's crippling. Um, and for us, what we found out, which we didn't know before we started all this, but historically, locksmith industry and the garage door industry had been abusing this Google business profile for years. People create fake, because the margins are really good, and it's what they call high duress service, um, meaning you lock your keys out of your car. Like, if whoever Google puts in front of you, if you call and they answer, like, they get the lead. It's very high conversion lead. So people create fake listings. They might create a Google pin at like a Walmart or a FedEx or something like that, and then they harvest those phone calls and they sell them to third parties, actual service providers. It's abuse of the Google business profile platform. And Google finally, in like last 2 years, started going to war and just eliminating as many, programmatically eliminating Google business profiles, and therefore also making it extremely difficult for new ones to stay on the platform and like maintain verification. They also are the only two industries where you have to go through what they call advanced verification in order to advertise. So we couldn't do any paid advertising ever on Google. And we tried Yelp, we tried some other, and it was just not good. Didn't work good. Cost per lead is too high.
Think if you'd PG to garage door business and that day hit.
Oh yeah, exactly. So, anyways, I posted about this. So we fought this, trying to get reinstated for 6 months. I hired numerous consultants. I even hired one of the consultants is the company who's actually been advising Google on identifying spam listings. Even they really were not able to get us reinstated, and ultimately, we just were stagnant for too long. I started another service business in the meantime, which was growing much more easily. And so I realized, time is your most valuable resource, and I was spinning my wheels, and it's time to cut bait and refocus on the other thing. And posted about that recently. Got a lot of, most people I think were like, they appreciated hearing about the failure, but a lot of people were really critical about me being over reliant on one marketing channel for my, for leads for business, and how that's not smart, et cetera. And I agree. But I also found that Google is like, if you don't have Google in your home service business, like, forget it. I mean, that's better. It's one thing if you've been in business 15 years and you've got organic ranking and word of mouth and branding and all that. But to start a new business without being able to advertise or be on Google, it's impossible in my opinion, to do it meaningfully.
Right. There's a bunch of stuff we can talk about with this, and it's
Yeah,
a really
yeah.
good story. But the best thing that I think, or one of my favorite things you said, and I think about this all the time, is buying a business versus just going and starting one. And there's so many of these, like, especially kind of service type businesses that you really don't need that much to start it. Like, sure,
Mhm.
in plumbing and electrical, there's like certifications, but there are people out there that have them that you could maybe partner with as like an operational partner and try to go do it and stair step your way up. Number one, you're not taking as big a risk. Number two, you're going to learn. I mean, most things you go and pursue, like, you learn pretty quickly in the first
Yeah.
6 to 18 months or something, whether you actually even enjoy doing the work, whether you're good at it, whether it's as good of a business and as profitable as you thought. And I feel like just going and starting something, especially something with a low barrier to entry, you're going to learn and find out, and you're going to fail quick or succeed quick. And then to me, there's just so much less downside with that. I mean, maybe you're out a little bit of money, but to your point of just going and buying something, and I've just never understood unless you're private equity and you can do it at scale and you have a formula and
Mhm.
deep pockets. I just have always recommended to people, it's like, don't go buy a landscaping business, just start one. Don't
Yeah.
go buy a garage door business, just start one. So I think that was very smart of you to do.
It. I mean, so what's funny is I posted this. We failed, and kind of this story of failure. However, I haven't done the math. I should have done this before today, but I'll post about it. Um, however, I mean, we made a profit. So like it was a failure because my goal was to create a multi-million dollar service business in one market, and that was my goal. So I didn't meet that goal, so it was a failure. But I didn't lose any money. I lost time, And so to your point, I think there's a lot of things you can go out and do and try if you have the time and the bandwidth to do it, and really not risk that much capital. And so, yeah, I mean, I think it'll probably be like if I calculate the IRR, it's probably a good IRR on my money, but not my time. So,
Yeah. Yeah, and that's
um,
hard to that's the other thing too is the time piece. I mean, it's you only have so many hours in the day and you can only direct so much focus towards one
mhm,
thing or the other. And I think there's like I've had the shiny object syndrome where I pursue something and luckily the things that have failed, they weren't big enough bets to where like it would have materially harmed my financial situation. But at the same time, it's like how much time did I waste? Like I
what's
chased this thing
opportunity
for
cost?
X amount of years. Yeah, the opportunity cost. Like had I just doubled down my focus on the thing that was already working, like how much bigger could that have been? And experienced that a number of times. I mean, we raised private equity in oil and gas to go do midstream stuff. Learned a lot. We built one asset that was like a push, sold it. It's been 3 or 4 years, like just chasing these big deals. And like, had we just doubled down on our core business, like, could it have? How much bigger could it have been? You know what I
Mhm.
mean? So it's just you learn a lot. But what about the fence side of it? How's that one going? What have you
Yeah.
learned?
Um, yeah. So we started a fencing business. A good friend of mine came to me, wanted to just hear about my experience with the garage door business back earlier this year. And that conversation ultimately led to us starting a fence contractor business together, Fortitude Fencing here in Tulsa. We have very complementary backgrounds. His background's in marketing, and kind of communications and stuff like that. And very different businesses. Garage door is smaller ticket, great margins, relatively low percentage of your cogs is labor. Um, you need to have in order to build a big business, you need to sell a lot of garage doors and a lot of garage door openers and do a lot of service. So um, fencing, very very labor intensive. Um, materials is still up to about half your cogs, but or 50% of your revenue, I guess I should say. But very labor intensive, very hard to keep and maintain labor, which is the moat which was what we kind of knew that going into it. But bigger ticket. So, typical job for us might be $6,000, whereas a typical garage door job average might be 700, 500. You have a lot that are 300, and then you have $2,000, $2,500 tickets. Um, and the other thing is there's no real service component, so you're pretty much chasing projects. Not a lot of recurring, revenue, obviously either. But it's been good. I mean, one thing we liked about it, because there's other similar, roofing would be similar, I would say. Um, high end landscaping we looked at, like not you know mow and blow type deal, but big fancy landscaping redesigns and that sort of stuff. What's nice about fencing is it's relatively discreet. So like you can subcontract jobs pretty easily if you have a good sub. You just got to make sure the quality is maintained and that kind of thing. But it's one page you can pretty much describe to someone what to go out and do and get it done, uh, as opposed to just more design intensive projects. We liked that about it, and I think that's proven true. However, just like anything, as you get into it, there's way more types of fences than I ever really realized, just because I never thought about it. Like there's a lot to learn. So it's been good though. Yeah, it's growing. We Last month was a record month. We did 76,000 in revenue. We started the business in April, so yeah, it's been good. I can see where that's going. I think the labor component is the trick. And we're trying to do something differentiated. Like we want to be an attractive employer for people who we think are going to increasingly go the trades route. It's a relatively simple trade. Like it's difficult for people to stay in fencing a really long time because it is brutal work. I mean, um, they learn skills. They learn how to use a saw, hammer, nail gun. And they can go out and do a lot of other things that's not as backbreaking, framing, trim carpentry, that kind of thing.
Yeah.
So,
Well, I would tell you, I don't know if you've probably already done this, but first marketing channel in my mind for fencing would be HOAs because like our
yeah,
HOAs forced me to spend so much damn money on my fence. It's like we'll have
yeah,
like they're like, hey, you need to restain your fence. I'm like, I just restained it like 3, 4 years ago. And then I
yeah,
spend like $2,500 on fence repairs and restaining it with some group. And it's like, okay. Or maybe like insurance adjuster. I don't know, like on the hail damage type of thing. But
yeah.
what do you guys
Referrals
do
are
on the
big.
marketing front?
Yeah, so that's evolving for us. I mean, the beautiful thing about the fence business that we couldn't do with Google or with the garage door business is like we had money to spend. Like we didn't show up without any money, so we were ready to just pour money into marketing, just create leads. Which on Google you can do that. You just start buying the clicks and buying the local service ads, and um, we had guys. So that's one, just paid marketing, paid advertising. Um, we're both, my partner and I are both Catholic. We're both pretty heavily involved in different parishes, different parts of town. So we leverage just a lot of relationship, community relationship there. And we had like 4,000 door hangers made and paid a couple of high schoolers to hang those uh, around targeted areas, targeted neighborhoods. Um, Done yard signs. I mean, I would say probably the highest return on spend for advertising thus far has been just putting a sign in a yard when you are building someone's fence. Because the neighbors all like one job, it's not uncommon for one fence to turn into like two or three neighbors, um, all wanting their fence worked on at the same time. It's kind of, yeah. So we refer what we're working on right now is like what you're mentioning is trying to build a referral network. Pool installers, like most people when they get a pool, you need to have some form of safety fencing. There's some requirements also uh, legally. HOAs, we have a job on the books for HOA. It'll be our biggest one. Got that closed. So a lot of it's just getting out there and getting referral and word of mouth too. It just takes time.
It does. Well, I mean, I think people underestimate the importance of the marketing stuff. I mean, it's like even with our land development deal, we just thought this is so awesome, like it's going to sell itself.
Yeah,
And then
yeah.
and it to some extent it did, but you had to get traffic. You had to have people see it. And when people got out there and saw it, they bought, or there was a high conversion rate. And so we worked with the group that really had the marketing dialed in, and we sent out multi six figures worth of mailers, which I thought is so old school. And the
Mm,
ROI on those dollars was incredible. Like it was just
interesting.
like you had all these people show up and actually see it. And so it's like, okay, if I have to spend, $100,000 to make 1 million or 2 million or whatever the conversion is, it's like that's a no brainer. Like you would just spend the
Hmm.
100,000, right? Like it
Yeah,
seems crazy at first. You're like, why would I spend that much money on this marketing thing? But I feel like a lot of small business owners just underestimate marketing and how big of a component that is. It doesn't matter how good you are, right? It's like if a tree falls in the woods, there's no one there to hear it. Like, does it make a
yeah.
sound? Like, I don't know.
Yeah, it's true. And like the bar, like in some of these trades, it's really not high. I mean, um, we have been in business 6 months, and we have more Google reviews than some of our competitors that have been around for 25 years. Like, and that matters. Like that for generating leads, that matters for customer. They look at that stuff. even other things like putting LLC in your name, like from a branding standpoint, you see that a lot. Um, just little things that you can do, just being novel, being kind of aware and a little more sophisticated, maybe. So it's been the way I see it is like trying to take the rigor and sophistication that we were used to, that we grew up in the oil and gas business, and just apply it to easier games. And that's essentially kind of been my philosophy up to this point. And now that I've kind of left the industry, so to speak, because the industry, what I loved about it, I mean, it is ultra competitive. Everyone is super talented, super hardworking, um, and that's that environment. That's not the environment in a lot of other industries. Everyone's well compensated, and so trying to take that kind of like a forge of sorts, forms you um, to really tackle like difficult problems. And so if you just put easier problems in front of those same people, they're going to figure it out pretty quick.
Right. No, that's great, man. Well, thank you for coming on and doing it. I'm glad we
Yeah,
got to meet. It's like it's a small
yeah,
world. We have a lot of stuff in common. And that's my favorite part of doing the podcast. It's just meeting people, having these
yeah,
conversations. Hopefully people listening to this that are thinking about doing some of these pursuits I think they would learn something from it. So
yeah,
again, thank you for taking the time.
yeah. They can reach out, find me on X, Karl_Luminus. Um, email me, Karl@luminuscapital.com. You can do that in the notes.
All right. I will do. All right. Thanks, Carl. Thanks, guys.